Hello everybody and welcome to another educational trading video from F45 Trade Signals. Today's video we are going to discuss trading in consolidations. Very important topic as you got to know what to do when price gets in these range bound trading regions. And today will be a fairly short session. We'll try to keep it around 10 to 15 minutes, and but very important one because there are several as price moves from day to day, you do get trapped in these consolidating areas, and they are very difficult to trade. And you got to know what you're doing. So you'll find this if you navigate to the website at F45 Trade Signals or F45trading.com and go down to the education section. You'll see video library right here. And it is actually one of the very last ones on the page right now, trading in consolidations. So we're going to get into this right now. I'm going to flip over to the charts. So what I have here is a price chart of the United States dollar and the Japanese yen. And this is a great example of range-bound trading. Now, if you look at this, and this is a daily chart, okay? So this is from a time period of basically 1 year. We're right now at the time of this video, it's January 29th, 2018. And the start of this trading consolidation started about the same time in January of 2017. So we'll just put the start and end dividers on that for now. So it's just this area here. You can see prices in a nice, well-trending, consolidating area. Now, we're not talking about a 15-minute chart or an hourly chart. This is on the daily. So there's plenty of opportunities in here to get long or to get short. And the total trading range on this, and this is the best part, is about 600 pips. So for all the swing traders out there and position traders, and day traders, you could even get in on a nice couple of day trades on this. This is what you want to do when trading in these consolidating areas. Now, you can also use this on a lower time frame. I would highly recommend you don't do anything lower than about an hour time frame, just because you want to maximize your potential pip profit. And on the daily, it's not going to get any better than this. So what we're looking at here, again, a chart of the USD yen, and prices started in this consolidation early January 2017. Now, you don't actually know. It starts in a small consolidating area in here, and really we're not getting a whole lot of areas in here that are high probability trade setups. So we would ignore this region, and I'll just maybe put a little box around here so you can kind of see what I'm talking about here. This area here we would definitely not want to trade in. It wouldn't be a high probability. So we'll just kind of X that out, okay? So everything in that box. But once price comes up here, puts in the final high, and then trades lower, now we're starting to get into consolidation. However, you don't know it's a consolidation, so it stops right here. You know, at some random point on the chart, it stops right here, and then it starts to go higher. What signals it as a consolidation is now it fails to break higher than this high over here, okay? So right at this red line is basically where I've got it. The bodies of the candles, and I'll zoom in just a little bit here so you can see a little bit better. The bodies of the candle fail to go any higher than the high up to here. So now you're kind of thinking, okay, price could be in a consolidation. So what you look at doing when price gets into a range-bound trading like this is you want to buy the lows and sell the highs. So everywhere I have an indicator, minus this one right here, obviously, because and I'll just put an X here so you know. Okay, so that would not, this one here would not be considered a trade because you don't know how low the market is going to go on this one. Okay, so again, it just kind of stops at some arbitrary point on the chart and then starts to go higher. What signals it is this guy right here, okay? So price comes up, it rejects off the high, trades lower, and then comes up right into here and rejects. And now this is where you'd want to get in on the trade. This would confirm the rejection that this is in range-bound trading right here. So I'll actually slide this guy over just a little bit and say right there. That's where you can go short, okay? Price comes all the way back down and trades. Now what I've done here is I marked this off at, let's say this is the consolidation, zero range of the consolidation, and this is 100%. I've got three other levels in here. I've got the 25%, the 50%, and the 75%. Now this is also indicative to the RSI, relative strength indicator. However, this is just manually done on the chart. So what I'm suggesting is every time price gets to one of these extreme areas, the 25% and the 75%, you can start looking at taking position. So when price comes back up here, so this would be a next trade, price comes up, it creates the consolidation high here and then starts to trade softer. Okay, so once price gets to the 75% level after this high here, you can start looking at taking trades short. Price runs all the way back down, comes again to the 25% retracement level. Now we can look at taking longs down in here. You see the price trade all the way back up again, 75% level. You got to wait and see what it's going to do, and it comes up, just pokes above this high and rejects, and the next level that you would be in on would be right here. This right before this big down candle right there. That's where you'd get in on your second trade to go short. You'd run it all the way down short. Now this one here in particular, it got down to this 25% level, so it's starting to get oversold and into the potential buy area. You could wait and see if price wants to take down this level here, which it does. So typically what you would want to do is you'd want to come down here, wait and see if price wants to break this level or reject and go higher. And you could take a long here. However, you just have to make sure you put your stop in correctly. And we'll talk about that here in a second, entering your stops and your profit takers. And then again, I'm just going to zoom out here a little bit. And then price comes in, just runs down, takes some market liquidity under these lows here, and then rejects, goes higher. And again, now price is coming up to this level here. You actually could have taken a small short rate in here as well too and rode this little motive wave down. However, you'd have to make sure your stop is again above here, but you may not have gotten in on this move just because it was very, very shallow. But there are a few pips you could have captured there. I mean, if I zoom in on that specific failure swing right there, let's say you got short rate at that level, I mean, that's 100 pips. That's a good day trade right there. So that would be your one right there. Price ran up again, just took out the highs here and rejected. You could have went short up here again for another trade. And then price comes up, rejects off the 50% level here, comes up. You could have taken another short trade here, and then it rolls over again. So that's basically what range-bound trading is. And now price just today has come down to another reflection point. It's failed to take the lows here. It's trading right off the base of this consolidating area, and I believe we're going to see price go higher. However, this isn't the candle you'd be looking at. It'd be tomorrow's candle to get in and see if price is going to confirm by continuing to go higher. So that's what we're looking at in range-bound consolidating trading areas. You want to go long when price starts to get overstretched and reach the outer edges of the bottom of the consolidating area, and you want to go short when price starts reaching up to the higher areas of the consolidating area, or trend, I should say. Now, just to go back a little bit, I mentioned something about stop placement. So what you want to do is you want to make sure that when you go out on a stop, you can when you put a stop in on your trade, that you give yourself enough room. So you want to pick the highest high and the lowest low. Now we're day trading here, okay? So we're expecting a good, let's say 600 pips, okay? You know what, for argument's sake, let's just say we went, we'll say 500 pips, let's say. As a good rule of thumb, you want to do at least a 2-to-1 trade minimum. Ideally, 5-to-1 would be preferable. So if we set up our trade, and let's say we went long somewhere down here, we would want to make sure we give ourselves, let's say we went long right at the very bottom, right at this red line right here. We would want to make sure we give ourselves at least 100 pips stop in order to make sure that price doesn't come down, sweep one of these lows, and then continue higher and taking us out of the trade. So you definitely want to reduce your risk on these large swing trades, but you want to maximize your profit by putting it up to these levels up to the 75 as your, put your first target at 50%, second target at the 75%, and your third target at the top of these range, at the high of the consolidation. So that's where you'd want to put your stops. And again, a minimum of about 100 pip stop underneath the low over here is where you want to put your stop. just depending on where you're getting in. Now, if you get in, again, on confirmation that price is going up, you can keep your stop a little bit tighter. You don't have to go with a full 100, but I would definitely suggest at least a 50 pip stop if you're riding the motive wave up. So that's really it. That's trading in consolidation areas. They can be done. They're very, very highly profitable. They're very predictable. But you just got to make sure when price gets down to gets up to these outermost regions of the consolidating areas, that you manage your stops correctly, and so price doesn't run into, like this one right here, where price just ran and just took stops out by what is the range here, by about 30 pips, right? So manage your stops correctly. Don't put them in too tight, and make sure you set your targets appropriately. Okay, so if I get in down here, again, my first target's going to be the 50% line, the second target is going to be the 75, and my third target is going to be the 100. And always, always, always continue to move your stop loss up. As soon as you hit your target 1, you move your stop up to break even. As soon as you hit stop 2, you move your, target number 2, you move your stop up to the 50% mark. And then obviously now, once the price goes up to target number 3, then you've exited the trade, you've paid yourself all along the way, and you're profitable. And they can't take it back from you once you've banked it. So that's the idea of trading in consolidating areas. They can be very, very highly profitable, and they're great to trade in, but you always want to keep to a few rules. Again, manage your stop loss correctly, move it as price is moving with you, and make sure you're not trading in too low of a time frame. Like I say, the USD yen, this is a daily chart, so these are all daily bars in here, so it takes a very long time for price to move up here. The higher time frames are the stronger trends in price and the more highly probable outcome and result that you're going to see trading these. I would highly not recommend trading any lower than a 1 hour time frame on a consolidation area like these, but again, if you know what you're doing, they can be very, very highly profitable. So with that, we're going to end the video education session. Thank you very much for your time. You can find all of these at F45 Trade Signals on YouTube, and again, navigate to our website at www.f45trading.com. Thank you very much for your time, everybody, and we'll catch you in the next video education series.